Great. So we've just gone past 6 o'clock. So I'm going to start now. I'm sure we'll have a few more people joining over the next couple of minutes. But welcome everyone to today's panel discussion entitled An Asset Class Deep Dive. My name is Shivani Oberoi, and I will be moderating today's discussion. I'm sure by now many of you are familiar with GAIN as an organization, but for those of you who aren't, I'll give you a very brief intro to GAIN and to myself before introducing our very talented panelists. As I mentioned, my name is Shivani and I'm an investment manager at Oxford University Endowment Management. I work as part of a small investment team investing the charitable assets of Oxford University, many of the colleges and many of the associated trusts of the university, with the goal of funding the university's research and education aims over the long term. I joined the GAIN team in December 2019 with the role of leading outreach initiatives in Oxford. For those of you that don't know, GAIN is a community of investors with charitable status that aims to encourage more women to apply for entry-level roles by informing and inspiring young women, debunking myths, and shining a light on female role models in the industry. Now, today's event is entitled An Asset Class Deep Dive. So before we dive in, I thought it would be helpful to define what an asset class actually is. So in its simplest terms, an asset class is a group of investments that have similar financial characteristics. We'll come on to talk about what some of these characteristics are, but some of the main asset classes are equities, otherwise known as stocks or companies, fixed income, otherwise known as bonds or debt, real estate, and commodities. So this panel event will shed light on the different asset classes within the investment management business, including public equity, venture capital, and credit. Our speakers will use examples to illustrate what these asset classes are, how they are investable, how returns are made, what the key risks are, and what their role is within a broader investment portfolio. So we want to make this discussion as interactive as possible, so please feel free to ask questions as we go in the chat box, and I will do my best to make sure they're all answered. So without further ado, I wanted to introduce our four fantastic speakers, Kiran, Maggie, Sophie, and Senan. Kiran, could you start off by introducing yourself and your background, as well as your current role and a description of the asset class that you invest in?
Absolutely. Hi, everyone. I'm actually a graduate of Oxford. I did PPE at St Anne's and graduated in 2000, in fact. I joined BlackRock, which is, I think, the world's largest money manager, straight out of university on a graduate program in 2001. And I've been a portfolio manager in public equities ever since. I currently work investing in emerging markets in a much smaller firm called Genesis, which is an emerging market specialist. So what are public equities? Public equities are, or investing in public equities is about investing in companies that are listed on stock exchanges. And that means that the companies are typically quite large and maybe a bit mature, relatively stable, and probably relatively slow growing, at least compared to some of the companies at an earlier stage.
Super, thanks very much, Kiran. Maggie, should we come to you next?
Hello, everyone. I am Maggie. I am the chief executive of an organization called Funding London. And what we do is we invest in venture capital. And I'll describe venture capital by reference to Kiran and public equity. So venture capital is investing in companies that are at the very beginning of their journey. They are companies that have just been started or have been around for 1 or 2 years, and they are usually developing brand new models that are based on new technologies or trying to disrupt a traditional industry. And so a couple of examples of this would be Monzo in financial services, or maybe Uber in the world of taxis. The companies that we invest in are not listed, and that means that you cannot easily buy or sell their shares. So as investors in these companies, we are investing in them for a very long time. But but equally because they are at the very beginning, it's very exciting. There's a lot of growth that's coming, but equally there can be failure. I've been in this industry for about 10 years, and before joining the venture capital world, I was a corporate finance advisor, and in what was called the mid-market. So I came to it through that route, and I went to university in the States and studied engineering, so had nothing to do with finance, really.
Thank you so much, Maggie. Sophie, let's move to you.
Hi, I'm very much looking forward to today's event, and it's great to see so many people on here. I work in high yield and leveraged loans. Now, that must mean perhaps not very much to quite a few people, as it did to me when I first started. I left university about 7 years ago. I studied history, and I moved into working in finance through a graduate program at Aberdeen Standard. I initially knew that I wanted to work in finance because I enjoyed economics and maths, but it wasn't the first thing that I thought of. That's how I managed to move into fixed income through the graduate program. I now work at Oaktree Capital, and I focus on high yield and leveraged loans. I think Senan's going to give a bit of an introduction to what that means when she speaks.
Great. So let's go on to Senan.
Yeah, very smooth. I'm Senan. Hello, everyone. I'm the Director of Research Europe for Muzinich & Co. Muzinich is a credit specialist with over $40 billion under management. I'm also a member of the ESG advisory group at Muzinich. Maybe we'll have time to talk about ESG as well. It's a hot topic these days. And I co-chair the Diversity and Inclusion Committee for European Leveraged Finance Association. Sophie already made a brief introduction to fixed income. So credit markets, the markets we work in with Sophie, come under fixed income, and fixed income instrument, as the name implies, pays a fixed interest until the end of their term. A bit like if you get a mortgage, an interest-only mortgage from a bank, you borrow a certain amount, pay regular interest payments until maturity of your loan. And at maturity, whether that's 20 or 30 years, you pay the original amount which you borrowed back to the bank, right? It's exactly like this, just the tables are turned this time. And we'll go more into the different instruments, I guess, later on, but that's very briefly what fixed income and corporate credit is about.
Thank you, everyone, for the introductions. That's great. I think it'd be fantastic to go into a little bit more detail now on some of these asset classes and the characteristics that each asset class exhibits, be that the profile of returns, the volatility, the period that you hold it for, how sensitive it is to the economic cycle. All those sorts of things would be fantastic to help our audience get a bit more of a flavor as to what that actually means in practice. So Kiran, maybe we can start with you again on that for public equity.
Okay, I'm going to start with to look at it or to describe public equities, but I'm going to also make some reference to the other asset classes because I think it kind of, it's really by comparison rather than absolute. The absolute's not going to mean very much to you all. So in terms of returns in public equities, 10% return a year is pretty good, and that probably sits it in the middle bucket of the return profile that we have amongst the asset classes that we're discussing. It's also probably in the middle of the volatility as well. It's not too high, not too low, and volatility means the path of variation of those returns every year. The holding period for investors in this asset class can be basically anything you want. Different people have got different investment horizons, time horizons, different investors have got different ways of making money. And as a result of that, different investors will decide to hold the stocks for different time periods. And because these companies are listed on stock exchanges, the liquidity and the ability to transact and buy and sell is quite high. They tend to be quite economically sensitive. Typically, rising economic activity is good for these investments, and they're correlated typically positively, perhaps, with VC type investments, venture capital, and maybe more negatively with bonds. That's the traditional view. Not always the case these days, not always the case over shorter time periods, but I think traditionally that is what you would say.
Great, thank you, Kiran. Maggie, let's talk a little bit about VC.
So VC, or venture capital, is, I would say, at the highest end of expected returns, and that is because one of the key principles of investment is risk versus return. And so venture capital has very high levels of risk, and by that I mean the risk of failure. And so in order to invest in a venture capital stage company, there is an expectation that there should be very high returns, and we are aiming at returns at the higher levels of, higher than 25%, all the way up to the middle 30s. That means that whenever we invest in a company, we need to believe that that is the potential return that we could get from this particular company. Now, it doesn't always work that way because there are such high levels of failure. And so the other thing that's key in this asset class is diversification. In other words, we do not invest in a single company. We need to always be focused on portfolios of companies so that we balance through the diversification, we balance the winners and the losers, and therefore that is, the strategy is never around a single company, it's around a portfolio. In terms of holding periods, because these assets are very illiquid, which means it is very difficult to buy or sell them. In fact, it is almost impossible to, unless you're selling the whole company. We tend to hold them anywhere between, I would say, 6 to 10 years and even longer, because that is the period of time that it would take this company to reach the levels of growth, and eventually it will probably be listed in the stock exchange. In terms of volatility, at the very early stages, which is when we get involved, there's a lot of volatility. There are lots of ups and downs as the company develops and tries to make a mark in the market and gain customers. And then as that company matures, the volatility will decrease. And then, if we're very lucky, we will see very high growth. I think those were the key things.
Great, thank you very much. And Sophie and Senan, let's go to the other end of the spectrum and talk about fixed income and some of the characteristics there.
Yeah, fixed income just like is on the other side of things, the exactly opposite of venture capital, because it's supposed to be safe. Like Maggie said, investment 101, higher the risk, higher the return. So lower the risk, lower the return, right? So and within credit, maybe Sophie can talk to that, investment grade and high yield, there is different levels of risk, which will pay you different levels of return. And Sophie, maybe you can explain how we determine which companies are high yield, which companies are investment grade. But to put a number, let's say a European high yield index would be returning around 4% these days for a maturity of duration of 3.5 years practically. And on the other side, there were some investment grade companies that you were actually paying to lend because the rates and the returns went negative at some point. And then in terms of the holding period, again, depends on what sort of strategy you have. If you're a long only fund, you can sit on it for years. Obviously, you're restricted by the maturity of the bond you're investing in, whether it's like 3-year bond, 5-year bond, 7-year bond, but you can obviously trade in and out. Liquidity, like how easily it is to buy and sell bonds. We don't have an exchange like the public debt people, public equity people. So it's quite primitive in the sense like the trading is done among the banks and the asset managers, the ones like Sophie and I work for, pretty much. And depending on where the market is, liquidity can dry up and you won't be able to sell your bonds if things get a bit risky and uncertain. But usually it's like decent liquidity. I will leave it at that, and maybe Sophie can talk about investment grade versus high yield, and also maybe the interest rates impact on the asset class.
Yeah, sure. So I guess like taking a step back and thinking about, what investing in this asset class looks like every day, it's not entirely uncomparable to, say, for example, what Kiran's doing with equities. It's all about businesses. It's all about understanding the drivers of business and, what's making it perform and whether or not we should be investing in it and whether it's a good investment. And part of that is just in distinguishing, what's the quality of the company. And to some extent, we can think about, very high quality companies. These will often have, very high credit ratings. And that's what Senan was saying about the risk versus reward. You get what you pay for. If you're lending to a company that's a high quality business, you can't expect to get much in return. However, investing in a very leveraged business or maybe a company that's got challenges, you can expect higher interest in return for that. So most companies that we look at have something called a credit rating, and that's an external rating from an agency. They tend to be S&P and Moody's, and these agencies will determine the rating based on how good the company is in their eyes, and that's how they fit into certain rating buckets. When we're looking at high yield, that's anything rated below a rating which is BBB minus. Anything below that is in the high yield bucket. Anything above that is in the investment grade bucket. So it's quite an easy way for investors to distinguish between higher quality companies and more riskier companies. Now we touched on the interest rate element of it. There is a certain sub-product in leveraged finance. Well, it's its own asset class really, and it's called leveraged loans. These are floating rate instruments, but we can think of it in quite a similar way. We're looking at quite similar businesses, but the instrument itself is floating rate, which means that we get some insulation to a rising rate environment, such as we're seeing now. So this instrument is more attractive to investors when we're more concerned about interest rate rises. But in essence, to simplify, we're still looking at a similar kind of businesses. It's just a different sort of instrument and ways to invest.
Thanks very much, everyone. I think we've done a great job at summarizing some of the key asset classes. But before we move on to talking in a little bit more detail about each of your strategies, we've had a great question come in, which is for Maggie, which is, can you explain the difference between VC, venture capital, and private equity? Is it just that venture capital invests in early stage startups, whereas private equity focuses more on mature companies? And that's a great question. We don't have a speaker here covering private equity. So Maggie, if you could address that, that would be fantastic.
Yes, of course. I would say that's broadly right. Venture capital, if you think of the word venture, is an adventure into almost the unknown. Private equity, yes, focuses on more mature companies, and whereas in venture capital, we're completely focused on helping a company establish themselves in the market, gain traction with customers, and grow. Private equity is more focused on either growing companies that have grown, significantly and now need help. Or the other very interesting area of private equity is where you buy a company that's not performing particularly well, and you might change its management team or change its financing structure to allow it to be more profitable. But yes, broadly the focus of private equity is in much more mature companies.
Thank you very much, Maggie. Good. Well, I think we will move to talking a little bit more about the investment strategies that you're all involved with. So we've talked about the underlying asset classes, but how do you actually invest in them, and what is the kind of broad strategy that you invest under? Kiran, let's start with you again.
Just clarify that just a second. So in terms of
just in terms of, well, for example, regionally or geographically, size of company, all that sort of thing. How does it all kind of fit together?
Excellent. Okay. So I invest in emerging markets. So that's companies that are listed in stock exchanges in places like China and Brazil and Latin America. So places that have got lower incomes typically. I invest across the capitalization spectrum, so small companies and big companies. Although when I say small companies, we're talking about companies that, smallest probably has a total valuation of $1 billion. So, these are not little tiny startup type companies. And we typically invest for quite a long time period. So our average holding period is about 5 years. So that's, it takes us 5 years before we crystallize value of an investment that we make. And in the world of public equities, that's a reasonably long time horizon.
And how are the returns actually made by investing in this?
Yeah, so the main way that we make returns is for the share price to go up, very simply, which means a capital gain. It's the primary driver of returns in public equities. And in turn, the increased share price is driven by 2 bits. The first bit is the earnings growth, or the earnings of the companies in which we invest. So if the earnings of the companies go up, typically so does the share price. And then secondly, the valuation that the market places on those earnings. If they think that the company's prospects in the long term are improving, then the market's prepared to pay more for it. So those 2 elements determine the return. And those are the areas that we focus on as equity investors. What are the earnings growth of the company, both today and then also in the longer term?
Super. Thank you, Kiran. Maggie, same question to you. Can you tell me a little bit more about the venture capital strategy that you follow, and again, how returns are made?
Yes. So we follow a strategy that is focused on technology, and that is either companies that are looking to build businesses around brand new technologies, or business models that are enabled by technology. And the importance of technology to us is that one of our key stakeholders is the Mayor of London. And so we have to focus on what is going to deliver growth and jobs. And so technology, by virtue of the fact that the business models are so scalable and can create so many jobs, is very important in terms of that growth strategy. Other funds might be focused more narrowly around specific sectors, whether it's financial technology, education, consumer facing businesses, or business. But I would say the broad common factor across any VC investor is technology, because I think technology is what's driving new technologies. How we make a return is, as I mentioned briefly at the beginning, we invest in portfolios. And so we invest in, we typically spend, so venture capital funds work on a 10-year span, and we spend the first 5 years building portfolios, investing in new companies. And then after the 5 years, what we tend to do is we stop adding new companies, but we start then supporting that portfolio and continuing to invest in those companies in the portfolio that are doing well. So through that strategy of diversifying and then supporting companies for a period of 10 years, we end up with a subset of those companies, usually around 30% of them, that will be the ones that will really deliver that return and move forward to bigger and better things. So we focus very much in picking companies where we think that the market opportunity is very significant and where the management team has demonstrated that they have the ability to, deliver it and grow it. So in what we do, it's not just it's not just the technology or the business model, is definitely the people that are there to execute it.
And then how do you actually end up kind of selling these businesses or exiting these companies?
Very good question. So there are two typical exit routes for venture capital companies. The first one of them is listing on a stock exchange. So there are many companies when they become very large and profitable, and that's the other thing, that these companies will take a number of years to become profitable, but eventually they will be large enough to be listed on a stock exchange. And the second way of exiting is by selling it to what we call a trade buyer. So somebody that sees our company as a great addition to what they do already, or many times is a bigger competitor buying a smaller one.
Thank you very much, Maggie. Sophie, shall we move on to talk about your strategy, and then we can go to Senan?
Sure. Well, we focus on Europe. So we're primarily investing in companies that issue in euros, but they might have American exposure, or they might have international exposure. It depends. In terms of the size of the companies, this also varies. It can be as large as Kiran's companies, but it can also be much smaller companies. So, for example, we may invest in a company that's got 80 million EBITDA rather than a billion EBITDA. So it varies significantly. The key thing that connects all these companies is that they're in the leveraged market. So they're sub-investment grade. That can either mean that they've got very high leverage, or it can mean that perhaps they're underperforming in some way. This depends. So it's quite a wide remit in terms of the types of companies that we're investing in.
Thank you. And Senan?
Our assets are global, so our funds have different strategies. Like Kiran, we have emerging market strategies. So when Kiran is investing as a shareholder, buying the equity, the stocks, we lend to those same companies. Then we also have developed market funds focusing only on the US or only in Europe. And within those geographical regions, we also differentiate between the asset class as investment grade and high yield. So we will have funds that will only invest in high yield companies, and investment grade funds that will only invest in investment grade companies. And when it comes to making our returns, so Maggie and Kiran is trying to maximize their return and the upside, maximize the upside, whereas what we are trying to do is minimize the downside. So we lend to the companies. All we want from them is to receive our interest when they're due, and also get our money back at the end of the term. So that interest we call the coupon in the fixed income world. But we can also make capital gains if the bond, when we are investing in, is below its 100, the par value. If you buy it at 95, so what would happen is you will collect your coupon through the life, and if you can get the money back at 100 at the end of the maturity, that will be your capital gain. So there are two elements to how you would make returns in the fixed income market, and the interest rate, Sophie mentioned at the beginning, is a main driver for returns in the fixed income market.
Interesting. And I guess the level of which aspect of return, so the coupon and the capital gains, the level of which is higher depends on the specific strategy in question. Is that right?
Also where you are in the cycle, where the interest rates are, because like I mentioned, like you had to pay to companies to lend them money not long ago, but now because we're a rising interest environment, things are changing. But then let's talk about COVID, March 2020. Some of the bonds that were trading at par at 100 went down to 60 in 2 weeks. So imagine buying that at 60, everything went back to normal. You have 40 points plus the maybe 2% coupon. Yes, in that case, the capital gain was the bigger part of the return, not the coupon.
Very interesting example. Thank you. And you talked about downside, which brings me on to another question that's been asked, which is, would you be able to walk through how you assess the downside of businesses when investing in credit? So Senan and Sophie, we'll turn that over to you.
Yeah, so you again, going back, all you want from the company is to get your coupon and your money back at the end, right? So I think we'll talk about how we analyze companies, or like how we do our job later on. But you do case scenarios, different scenarios to see how bad things can go and where the valuation of the bond would be in that scenario, how likely that scenario is to play out. Well, COVID, nobody expected, right? So everything was too expensive in February compared to March in 2020. But it's by doing the fundamental analysis, you determine what's the downside risk. Rating is a good implication of how risky the company is, right? We talked about that already. And also, you can, when you do the scenarios, you can stress test the company. So you assume the worst case scenario, will this company survive this kind of worst case scenario, and then eventually pay my money back.
Great, thank you very much. Fantastic. Good. Well, I think one more question, just as a broad overview of the asset class, and then I think we should move on to talking about the investment process and some examples. But I just wanted to ask to get a sense of who your different clients are for each of these strategies, each of these asset classes. What sorts of client does your asset class appeal to? So maybe Maggie, we start with you on this one.
That's a very good question. So the types of investors in our funds will be those that are seeking a very high return and have a high risk appetite. So one could divide potential clients or investors in our funds according to their risk appetite. In the UK, which is very different to the US, the sorts of investors in VC funds will be family offices, which tend to be, very wealthy, high-profile families that are trying to apply their wealth towards promoting new companies. We also have a lot of wealthy individuals that can invest in these funds relatively small amounts through a number of schemes that the government offers. But yes, those I would say are the two main types of investors in funds. And whereas in the US, for example, you have a lot more pension funds and other very large institutional investors, but that's because VC funds in the US tend to be much bigger than they are in this country.
Thank you very much. Sophie and Senan, I think let's go to the other end of the risk and return spectrum. So who are the sorts of clients or investors that you have in your funds?
I can go very briefly. For Muzinich specifically, our clients are mainly institutional money. So you might hear the term in the market, institutional versus retail money. And retail is like individuals, people on the street, basically. If you open the middle pages of FT, you'll see all these funds where you can, as an individual, can invest in. We don't cater to that market. So our clients would be mainly pension funds, insurance funds, like we pay all this money to our pensions, insurance, like they cannot just sit on it, it will just evaporate, right? So they give it to asset managers, whether it's the public equities or even venture capital, alternative investment, and some to fixed income to companies like mine to invest. So those would be the bigger clients.
And very similar to Muzinich, Oaktree have a very similar kind of client pool.
Great. Thank you all. Well, let's move on to talk. Oh, well, sorry, I have missed out Kiran. Kiran, please go ahead. Tell me about your clients.
Well, it's actually very simple. I think public equities is basically anybody who wants to benefit from the global economic growth or country-specific economic growth. So yeah, could be anybody, ranging from individuals through to very large institutions.
Mm-hmm. Great, thank you. Well, let's move on to talk about the actual investment process. So if you can give examples here, that would be really helpful to give our audience a bit more of a flavor. But effectively, I think what would be helpful to explain is, how do you find new investment opportunities to begin with? So what exactly are you looking for? We've touched on some of those traits and characteristics, but let's start with that. Then we can go on to talking about how you analyze a potential investment, the modeling you do, what the due diligence process looks like, and then what happens after you make the investment. How do you monitor it? Do you do something to add value? How long do you typically hold for, and how do you ultimately sell, or do you sell? So let's start with you, Kiran, and go through that.
Do you want me to go through the whole thing, or just to start with the kind of?
Yeah, maybe just go through the whole thing, so we can see the whole life cycle.
The whole process. Okay. So we invest in companies, and we're trying to find great investments. You know, a great investment for a company is typically a company that has got some kind of competitive advantage, some kind of differentiation factor. A growth opportunity ahead of it, a good management team that can take advantage of that growth opportunity and allocate capital and resources well to grow their businesses. A company that treats all their stakeholders well, that means their shareholders and their employees and the environment and all of the other interested parties, and all wrapped up in a reasonable valuation. So those are the kind of companies that we're looking for. And because I invest in emerging markets, let me just take you through maybe an example of an emerging markets company that I've invested in. So 3 or 4 years ago, we went to Vietnam. So Vietnam is one of the countries with the lowest GDP per capita in the emerging world. It's growing very fast, and the stock market there 3 or 4 years ago was just beginning to open up, and we were looking at a number of companies that had listed to see if we could find some companies that fulfilled those criteria that I just discussed. And we came across this company called Mobile World. Now, Mobile World is was at that point, and still is, the largest retailer in Vietnam. And that was quite an exciting proposition for us, because we knew that the retail industry in Vietnam was incredibly underdeveloped, and that over time there would be a big shift from people buying stuff in the traditional trade, in small mom and pop informal retailers, into more formal retailers like we see, in the UK and in developed markets. And this company, so it not only had a good growth opportunity ahead of it, but it was also, because it was the biggest retailer in Vietnam, and there was really no other competition in formal retail. They were really the only guys in town who understood how to run a retail business. So they knew how to analyze a shop or where to open a shop. They knew how to provide great customer experience. They knew how to beat up their suppliers to make sure they got the best prices. And so, they had a set of skills that should enable them to kind of beat the competition through this growth profile period. And it's run by the founder. That's always a good sign. So the guy who set up the business was still running it. He's a young guy, and he owned lots of shares in the business. So he was really incentivized to grow the business and deliver returns for shareholders like us. So kind of ticked all the boxes that we were looking for. And so we went through a due diligence process on this company. So, we're fortunate enough, we go to Vietnam a couple of times a year. So, we met the company over, a reasonably extended period, because when we invest, we tend to be investors for quite a long time. So it's worth getting to know the company well. And over maybe 18 months or so, we met the founder. Is he honest? Is he capable? We met the competitors. Are they rubbish? Yes, they were. We went and had a look at the stores. Go and kick the tires. It's always useful. They were running grocery stores. Do the vegetables look fresh? Does the fish smell? Do they have any supply chain problems? We talked to some consultants to try and understand their pricing. How do their prices compare with traditional trade? We spoke to their suppliers. Do they get the best prices from the suppliers? What do the suppliers think about this company? That's normally, they normally have good insight. And all of those things were coming back, pretty positive. We also thought about the macro environment in Vietnam. Is Vietnam going to be a place where, the economy is going to be growing over the next 5-10 years? And the answer for that was a resounding yes. And we looked at the valuation. And for various reasons at that point, Vietnam was out of favor. They just had a big credit cycle, and people were worried that the economy was going to continue to struggle. And it just wasn't a very popular place for foreign investors at that time. And so the valuations were actually very reasonable. And so we invested. And we would expect to get over 10% return per year for this investment as it continues to grow. And it's got probably at least a decade of good growth ahead of it as the formal retail industry develops in Vietnam, and the economy also grows. And so now we're sitting on it, and it's just a question of making sure basically that nothing goes wrong. And for this company, the big threat to it is the rise of e-commerce. So e-commerce is just getting underway in Vietnam, and we've seen how disruptive that can be for retail industries elsewhere in the world. So that's something that we're really focused on, to try and understand their response to the e-commerce threat. And we will wait and see, and we'll sell it if it becomes too expensive. We think that the stock has priced in all the value that we can see this company creating over the next decade or so. Or we think that something fundamental is happening in the business, which means that it's not going to do so well over the next decade. Hopefully that gives a flavor.
Thanks, Kiran. That's fascinating. It's great to hear the whole spectrum of the diligence work that you do, from the kind of on the ground stuff to thinking about macro, to the financial modeling. So thank you. That's very, very helpful. Maggie, let's move on to talk about an example from you.
Yes, so we tend to find our investment opportunities either through direct introductions by other investors or by other advisors, or companies can come directly to our funds. They can, submit a business plan through the fund's website, or simply by picking up the phone. The key thing in my industry is that each investor has a specific strategy and a set of expertise, and so the businesses that we will invest in will have to be something that we can understand, that the people in our teams and our investment managers can evaluate and really understand the opportunity. How do we analyze an investment? Well, because these are brand new companies, we focus mainly on two things. One is, what is the market opportunity? How is it quantified? And why is this? A question that we always ask potential companies is, what is the problem that you're trying to solve, and why does it need solving? And if they can't articulate that, it's very difficult for us to believe that somebody out there is going to buy their product or their service. And then it's about the management team. Do they have not necessarily the skills, because a lot of the management teams that we backed will be from completely different industries. It will be investment bankers that want to start something completely different, but it's more about what is it in their character or the way they have looked at this business that tells us that they'll succeed. And so that's the key thing we do. These are brand new companies, so there's not a lot of actual due diligence that we can do on them. It's all about the market. And in terms of valuation, because these companies often have very little revenues, if they have any, they're not profitable. And so we can't really apply the usual metrics around, multiples of profit or multiples of sales. So we have to look at, how much does this company need to grow in terms of the market that they can address for us to be able to, for the valuation that we invest in. Say we invested at £1 million valuation, what would it take? How much does this business have to grow, and what does its market share need to be for us to make a good return, and then work backwards from there and say, okay, do we think they can do it? So it's very different. An example of a company that we've invested in, it might be it might be a brand that people recognize, is a company called Gusto, which is a recipe box delivery business. We invested in this company back in 2013 when it was just getting started, and the founders had wanted to really address the issue of busy professionals that are eating out a lot or ordering a lot of takeaway, and how unhealthy that was becoming, and how much waste there was, both in terms of packaging and food waste. And so they created this concept of, you can go on their website and buy a meal kit, either for 2 people or for families, and it's exciting because it's recipes that you might not necessarily cook at home, and more importantly, the kit that you get will have all the ingredients, however obscure they might be, a particular herb or a particular spice, in the right quantity, so there is no waste, and it's really exciting. And so the other thing that this team, their strategy was focused on, is in using machine learning, or what we call artificial intelligence, to create algorithms that would help them optimize the level of food they were buying and holding in their website, in their warehouses. And they did this by using a lot of the information that their customers were telling them around, what recipes they were picking, how often they were ordering. And so that business has become, it grew quite quickly, became very successful, and it went from a valuation of a few £1 million to more than £1 billion 8 years later. It has grown incredibly. It was London-based, and now it has operations all around the UK. And the really interesting thing about this business is that when COVID hit, we didn't really know which way this business was going to go. And of course, because there were no restaurants and people needed something exciting to do, it actually grew quite significantly during the pandemic, and has had to manage way more growth than it ever thought it had to. The fund managers that are invested, involved with this business have helped it in many ways in terms of how we've added value. It's helping that management team manage the growth when you go from 5 people to hundreds and hundreds. There is quite a lot of very quick learning that you have to do as a leader of that business, and understanding what are the processes that you have to put in place to help that business be a manageable business, and a business where you can hire the right employees and the right board members, and yeah, and the other very key thing that we did for them, because they grew so quickly, it had to bring in new investors, because one of the things that I haven't talked about is the fact that in venture capital, you invest in syndicates. You don't invest by yourself. You invest with other investors. And one of the reasons, well, two of the key reasons are that you have to diversify that risk. You can't just take the whole risk of failure by yourself. And so other people come in, but also, and more importantly, when that company is growing, no single fund will have the funds to help that company grow to £1 billion. And so we did a lot of work in helping Gustav find other investors to come in later as the business grew.
Thank you very much, Maggie. Great example there. And I actually use Gusto, so I know the company. I'm just mindful of the time. So maybe we just do one more brief example, either Sophie or Senan. Happy for either of you to go, and then be great to answer a couple of the Q&A questions and talk a bit about career advice in the last 10 minutes.
Oh, I just saw a question actually in the Q&A section. Maybe I answer that while talking about how we analyze the companies. The question is about financial modeling for equities and debt. So some parts will be similar, but Karen's analyst models will be a lot more complicated than ours, and they will be sheets and sheets and sheets, I'm guessing. So
not necessarily.
So we don't care about the EPS or like earnings per share. We don't go that further down in the P&L. Like we stop at EBITDA level. And for credit analysis, one thing, if you need to remember one thing, remember this: cash is king. If the company is not generating any free cash flow, they will not be able to pay your coupon back and then your debt back at the end of the maturity. So our focus is a lot on the cash flow and certain credit metrics. When it comes to valuation, again, Karen's world will have they will do DCF or some other sort of valuation, and they will come out with a target earnings per share number. Whereas in our world, we use a method called relative value. Sophie, do you want to talk about relative value briefly?
Sure, happy to. I mean, when you're talking about relative value, do you mean talking about how different bonds compare across the structure?
Exactly, like how we make our investment decision, because we cannot calculate a fair value for the bonds. How do we decide which bond to buy, looking at the relative value?
Yeah, sure. I mean, maybe without looking at the actual instrument, just in terms of how, for example, Karen's business decision will differ to our business decision. You know, Karen talked about competitive positioning and talked about, growth in the business, and we care about all those things. But as Senan said, we care about, getting paid back. And part of one of the key things with the whole cash is king aspect is, how aggressive are management? How aggressive are they in terms of the dividends they make to their shareholders? Or are they like to make lots of acquisitions? All those aspects are very important for us, because those aspects drain cash flow. In terms of, as Senan said, in terms of relative value, when we're looking at different bonds, we'll be thinking about the different coupons that different companies will pay, or different bonds pay. And then we'll be understanding, the risk reward. Are we getting paid enough for the risk of this company? And it's a bit like if you were to lend to your pool of friends, if you're looking at them in terms of, how much are they spending every month versus how much is actually coming in. And would you rather lend to friend A or friend B, and you're assessing them on the basis of how likely they're to pay that every month to you, but also how likely they're to pay you back in 4 years' time. So we're thinking about those things. When are you going to get paid back? The maturity of the bond might be 3 years, 4 years, 5 years, or it might be 1 year. So you might not care about as much what the company's like in 4 years if your maturity is 1 year. There are many different things, but again, it comes back to the quality of the business and the length of time you're lending to a business, and how much you're actually getting paid for that.
Thank you very much. Great. Well, I think in the interest of time, let's move to talking a little bit about each of your career paths and some advice you might have. Sophie, I think as the most recent graduate, let's start with you. I know you touched on your background a bit to start with, but would love to hear a bit more about your route into investing in this asset class and the sorts of skills you think people might need to be a good investor in that asset class, and then finally, what sorts of investment roles are available to young graduates out of university? How would you recommend that they get into this space?
Sure. I mean, I think first things first is I'm probably a good example of someone who didn't necessarily intend to go into finance, but I'm really glad I'm here. I mean, for a start, I did history at university. I think the first instance, I thought I wanted to be a lawyer. And I actually did quite a bit of work experience in a couple of law firms over a couple of summers. And what I realized when I was there was that the things that were sparking my interest was much more on the finance side. So I worked in the hedge fund financing team, and I was thinking, how does this work? How are these people making money, or how are these businesses working? And at that point, I got some very kind advice, was to say, if you're interested in this, you should go into finance, not necessarily law. And I'm really glad I did, because I think it's an incredibly rewarding career. I mean, before I sort of say why I think it's great, I mean, in terms of how I actually got into it, I did an internship at Aberdeen Standard over a summer. So I just applied through their website. I picked a couple of asset management firms that I wanted to perhaps work for, applied for their internship and did their internship. And then at the end of that, got offered a graduate role, which was great because we were able to rotate every 4 months into different areas. So I actually did a bit of private equity, I actually did public equities. And for me, when I was there, I realized I liked looking at businesses and understanding, how they worked and what made them tick. And credit was the area that I enjoyed the most, and the types of analysis that we did there. But I actually think, there are lots of comparables between the different asset classes. So it doesn't matter if you don't know exactly which one you want to do first. It's just about getting a bit of understanding about all the different areas. After a couple of years at Aberdeen Standard, I really wanted to focus on leveraged finance, which is why I moved to Oaktree, and here I've been here a year and a half now. So that's sort of how I ended up here.
Thank you very much. Maggie, I wonder if we could talk about your route into venture capital and any advice you might have for students looking to enter this space.
So my route to venture capital came through finance. When I left university, having studied engineering, I realized that I didn't want to do engineering. So I went to a management consulting firm, and very much like what Sophie is describing, I very quickly became very focused on the financial analysis that I was doing as an analyst in a consulting firm, and from then I realized that what I needed to do is to seek a path to finance. I then went and did an MBA and then went into investment banking. I think the career paths to becoming to joining a venture capital fund tend to be either through finance or accountancy. So a lot of graduates that do an accountancy qualification and qualify will then will then take those skills to a VC fund, or equally, if you've done a couple of years as an analyst in an investment bank, those are really great paths because a lot of the financial analysis that we do is taught there. The other path, of course, is through business, through getting a couple of years of experience in a business, either joining as a graduate in a corporate or any other type of business experience, because that is the other side of investing in companies, to be able to understand the business model and the key drivers. So I would say those are the paths that work really well.
Thank you. That's very helpful. Kiran, what about you? What was your path into public equity, and how do students get into public equity as an asset class?
Yeah, so I had a very traditional graduate route in. So I did an internship actually sponsored through St. Anne's. One of the St. Anne's alumni offered an internship in her fund management company in New York. And I was fortunate enough to get that one summer that I was at St. Anne's. So I learned a little bit about the industry then. And then when I graduated, I went through the mock round and applied to various fund management companies and got offered a job by BlackRock. And I would say that a graduate scheme at one of the larger asset managers is a fantastic way into the industry because of the breadth of experience that you're offered. And as Sophie said, typically you can try out a few asset classes and see what you like or what suits you, more importantly. And then the other traditional way in is post MBA. So if you make a full start on your career and decide that actually you'd like to be an investment manager later on, then go and do an MBA, and you can join lots of firms recruit out of those schools. And I would say, I think the skills that you need to be a good investment manager in public equities are quite distinct from perhaps many other careers. You need that analytical ability. I haven't ever met a good fund manager that's not super bright. But at the same time, it's all about decision making under uncertainty. So you've got to be comfortable with making decisions without knowing all the facts, and also got to be comfortable with being wrong lots of the time. A good fund manager is only going to be right, 52-55% of the time. So the psychological pressures of that is actually quite tough. So you need to be robust. And I think if you're thinking about fund management as a career, the Super Forecasters book by Philip Tetlock is excellent to explain some of the kind of psychological attributes of great investors. So I would highly recommend reading that book and thinking about whether you have those kind of attributes that the Super Forecasters demonstrate.
Thank you. Great recommendation. Let's wrap up by asking the final question to Senan. Any final advice or tips into how to get into credit or fixed income investing?
Network. Like I told Sophie, maybe I don't know how many years ago, the same thing. Network. Definitely talk to people. LinkedIn, use LinkedIn, do internships. Sophie said the same thing, Maggie said the same thing. Like you find out what that thing really is when you do it. Actually, accounting, I think Maggie mentioned, pay attention in your accounting classes. It might sound boring. Actually, I find accounting fascinating. It does have a logic to itself. It's not, depends on who teaches it, I guess. We had a fantastic teacher. Everything that happens in a company will convert themselves into numbers in accounting. It's the kitchen of the company. If you understand accounting, you understand many things. And I think in fixed income, there are different types of roles. You can become a credit research analyst. You can become a junior portfolio manager. You can become a trader. Or that's like mainly the front office, we call it, or you can, be in different functions like sales or client relations. Don't think fixed income or investment is just shouting numbers and stuff like that. It's much wider than that. Talk to people, understand what it involves from different people would be my advice.
Super. Thanks very much, Senan. Well, we've gone past 7 o'clock, so I wanted to say a huge thank you to all four of you for sharing your insights today into a few of the many different asset classes. And I hope all of our audience found that very useful. So thank you very much, Maggie, Sophie, Senan, and Kiran. If you don't already, I would particularly encourage all of you to follow us on Instagram at Girls Are Investors, where we share updates, inspiration, and work resources on a regular basis. And you can also check out our website, gainuk.org, which shows a full schedule of our events, as well as some other helpful resources and job postings. So thank you very much, everyone. Hope you all enjoyed the event today and hope to see you all at another event soon. Thank you. And thanks again to our speakers.
Thank you.
Thank you.